Hello and welcome back to the Deep Dive. I'm so glad you could join us today, December 23rd. We are right on the edge of the holidays. And since we'll be taking a short break tomorrow and Thursday and then resuming our normal schedule this Friday, I just wanted to wish all of you who celebrate a very, very Merry Christmas. But before we all get to the eggnog, we have to talk about what's happening in the markets. We are seeing a truly historic divergence. The price action in gold, Bitcoin, strategic metals, it's just unprecedented.
It's much more than just volatility. I mean,
What?
our sources today are all pointing to the same thing, an irreversible structural change in global finance. It's being driven by, deep fiscal issues and some really acute geopolitical stress. Our mission today is to break down exactly why those old market rules are obsolete now.
And why these key assets are moving in such dramatically different directions. It's like a new hierarchy of safety is being established in real time.
It is. The data from today, December 23rd, really tells the story. Just look at gold. It has powered through $4,400 an ounce, even hitting above $4,460 recently.
And silver's not far behind.
Not at all. It's near $70 an ounce. I think it's at $69.44. These are successive all-time highs.
But then you look at the other side of the ledger, Bitcoin. It seemed unstoppable this fall, hitting $126,000. Now it's in a sharp correction, trading near $88,000.
Gold is confirming its status as the ultimate safe haven, while Bitcoin is, it's behaving more like a leveraged tech stock.
Okay, let's unpack this. Let's start with gold and the old rules it used to play by. For the last 2 decades, the playbook for gold was simple. You just watch U.S. real yields, right? The returns on Treasury inflation-protected securities, or TIPS.
Right. The logic was, if real yields went up, gold went down. It was almost a law of physics for the market.
Because holding a U.S. bond that paid you a real inflation-adjusted return made gold, which pays nothing, look unattractive.
And that decades-long paradigm is now, as the sources clearly state, obsolete. We've entered what analysts are calling a fiscal dominance regime. Between 2005 and 2021, the inverse correlation between gold and the 10-year real yield was an incredibly strong negative 0.84. They were almost perfect mirror images.
So if one went up, the other is almost guaranteed to go down.
Exactly. But fast forward to today, late 2025, and that correlation hasn't just weakened, it has completely flipped. It's now in positive territory, plus 0.23.
That's a massive financial anomaly.
It is. Real yields are still high. They're around 2%, but gold just keeps hitting all-time highs.
Okay, wait, let me stop you there. Because for the listener trying to get their head around this, if I can get a guaranteed 2% real return on a safe U.S. bond, why on earth would I buy gold? Isn't that just irrational?
That's the core insight. And the answer is no. The market is rationalizing a much deeper fear. It's no longer pricing gold based on the opportunity cost, of holding fiat. It's pricing it as insurance against the solvency risk of the issuer.
The U.S. government itself.
Exactly. Fiscal dominance just means the market believes the deficits are so large that the only way out is future monetary debasement. You're buying gold as a hedge against bad policy.
And this isn't just a theoretical fear. We're actually seeing it in the bond market mechanics with the return of the so-called bond vigilantes.
Yes, there's a visible erosion of confidence, especially in long-term Treasury debt. The sources are all pointing to the Q4 Treasury auctions. The 20-year bond auction this month, for example, showed a significant tail.
Can you break that down for us? What does a tail mean in simple terms?
A tail means the final yield investors demanded at the auction was significantly higher than where the bond was trading right before. It's a signal that investors are nervous, so they demand a higher risk premium, a sweeter deal just to buy it.
And what about the demand side? Was it strong?
It suffered too. The bid-to-cover ratio, which just measures how many bids were received for every dollar of bonds offered, fell to a pretty worrying 2.46. That's well below average. It signals real buyer fatigue. The vigilantes are back. What's fascinating here is that traditionally, rising yields would be bad for gold. But today, these higher yields are not seen as an opportunity. They're being read as a credit risk premium.
So investors are demanding to be compensated for the fear of future inflation.
Precisely. That's why gold and yields are rising together. Yields are up because of fiscal stress, and gold is up as the insurance policy against that exact same stress.
So if the fiscal problems are the slow-burning engine, geopolitics just threw gasoline on the fire. We saw a very specific trigger just in the last few weeks.
Absolutely. The severe escalation of naval tensions between the U.S. and Venezuela, the interception of oil tankers, the threat of a blockade, that was an immediate reminder of how fragile things are.
And the market reaction was instantaneous.
Gold jumped 2% in one session. An event like that, where physical assets are literally seized, it just drives home the insecurity of relying on financial assets. It pushes central banks even harder towards tangible gold reserves.
Which brings us to official sector demand. This has been the massive, inelastic floor under the gold price all year.
Correct. Central banks have already accumulated over 634 tons year to date. And their motivation isn't just portfolio optimization anymore. It's about defensive de-dollarization. It's national security.
So who are the big players here?
You see a very clear trend. Poland's national bank is a huge buyer, hedging against instability in Eastern Europe. They're targeting 30% of reserves in gold.
In China, of course.
Of course, China's PBOC is buying steadily every month to reduce its U.S. debt exposure. And then you have countries like Brazil re-entering the market, aligning with that broader BRICS plus strategy.
It really sounds like nations are preparing for a world where their dollar holdings could be a vulnerability.
It's a strategic move. And here's the crucial detail. 66% of the demand in the third quarter came from unreported sources.
Unreported, so sovereign wealth funds, maybe?
It implies shadow accumulation? Yes.
Yeah.
It suggests the real demand pushing that price floor higher is significantly greater than what the public numbers are telling us.
That's a powerful point. And if central banks are focused on tangible assets for security, that idea extends beyond just monetary gold, doesn't it? Okay, just a quick pause. If you like what you're hearing today, we invite you to subscribe to the channel, leave your like, and comment on which topics you'd like us to cover in upcoming deep dives. In the description for this deep dive, you'll find two important links. One to our sponsor, Broker360, and another to PayPal if you'd like to support this project. Your contribution greatly helps us continue making content like this. We only ask for the price of a cup of coffee. Thank you for your support. Now let's shift from monetary gold to the strategic industrial metals. Here's where it gets really interesting. Silver and copper are no longer just cyclical bets. They're becoming instruments of national security.
The silver market in 2025 has been just explosive. It's actually outperformed gold, soaring about 140% this year. The gold to silver ratio has compressed from 90-to-1 down to 64-to-1.
So what was the game changer? What changed its fundamental status?
It was a regulatory move in November. The U.S. Department of the Interior finalized the inclusion of silver on the critical minerals list.
And that's not just a label. It has real-world implications.
Huge implications. It means silver mining projects can get prioritized federal permits, what's known as the FAST-41 process. That can shave years off development. It also opens the door to government subsidies under the Defense Production Act. It's a massive validation of the scarcity thesis.
And the scarcity is real, especially looking at the demand side.
Oh, absolutely. We're now in the 5th consecutive deficit year. The accumulated gap is over 800 million ounces since 2021. And industrial demand is becoming exponential. First, solar panels. Photovoltaics now consume nearly 30% of all industrial silver.
And the second driver is something that's, well, it's reshaping everything. Artificial intelligence.
It's a severely underestimated factor. High-performance AI data centers require incredibly efficient power management. That means high-grade silver connectors. Silver's conductivity is critical for reducing energy loss. This is creating a massive new demand vertical that competes directly with investment.
That's fascinating. Copper seems to follow a similar story, with its price spike up over 35% this year, but for slightly different reasons.
The copper market is suffering from a very acute supply distortion. We're calling it economically trapped copper. It's a direct result of aggressive tariff threats.
So merchants rushed to get their supply into the U.S. before the tariffs hit.
Exactly. They rushed somewhere between 730 and 830,000 tons of copper into CME warehouses in the U.S., and now it's trapped. The tariffs make it uneconomical to re-export it to where the physical demand actually is, in Asia and Europe.
So it's artificially draining liquidity from the rest of the world and spiking the price.
Right. And JP Morgan is already forecasting a refined copper deficit of over 300,000 tons for 2026. Copper is the bottleneck for the entire global energy transition.
Okay, let's circle back to the Great Divergence. We've established gold supremacy and the tailwinds for silver and copper. But why is Bitcoin, the supposed digital gold, down 30% from its peak?
You know, Bitcoin has really failed its key test of 2025. The data confirms it's still a high beta, risk-on asset. It has a strong positive correlation, about 0.8 with the NASDAQ 100.
So when the U.S.-Venezuela crisis hit, gold rallied 2% on fear, but Bitcoin sold off. It acted like a tech stock, not a refuge.
That's the takeaway. In moments of acute geopolitical fear, institutional capital liquidates crypto to reduce risk. They don't rotate into it for safety. It's still viewed as a speculative option, and that correlation is its Achilles heel right now.
But there's a huge paradox here in the flow data. Institutions are accumulating massively, even as the price falls. How do we square that? BlackRock is pouring billions in while the price is tanking.
This is the central conflict. It's strategic buying versus structural selling. BlackRock's IBIT ETF has seen staggering net inflows of $25.4 billion this year, making it the sixth largest ETF in the world. But here's the thing. The ETF itself has negative year-to-date returns. This tells you that institutions are systematically buying the dip. They believe in the long-term story.
So if demand is that high, what's pushing the price down so hard?
It's being neutralized by massive selling pressure from the mining industry. The 2024 halving compressed their margins severely. The mining equilibrium index is signaling critical stress. Less efficient miners are being forced to sell their accumulated Bitcoin, their HODL stack, just to cover costs and service debt.
So that constant supply overhang is just absorbing all the new institutional money.
It is. It's preventing the price from reflecting what seems to be a huge level of long-term demand.
Looking to 2026, is there any light at the end of the tunnel, regulatorily speaking?
There is some long-term optimism, yes. The new administration's appointment of Paul Atkins as SEC chair, it's a big deal. He's known to be very pro-crypto, pro-free market. He's promised an end to regulation by enforcement and wants to establish a clear taxonomy for tokens.
But that doesn't fix the immediate problem.
No, it doesn't. It's great for long-term clarity, but it does nothing to solve the immediate liquidity and miner stress. Bitcoin is caught at a crossroads, what one source called an encrucijada, a very uncomfortable place to be.
So we've covered three distinct asset classes, all playing by different rules. What does this all mean for the listener heading into the new year?
I think there are three very clear strategic takeaways. First, gold. It is the undisputed secular winner in this fiscal dominance regime. The fact that it's rising with real yields is the final proof. It is the only true counterparty risk-free asset when the market doubts sovereign debt.
Second, silver and copper are no longer just cyclical plays. They're strategic geopolitical investments. They're critical for solar, AI, electrification. That critical mineral designation for silver really cements that thesis.
And third, Bitcoin. It's an asset in transition, a speculative option on future tech adoption. It needs to shed its correlation to risk assets and get through this wave of miner selling before it can even hope to act as a true geopolitical refuge.
So the sources are recommending a very clear distinction in portfolios for 2026. You need to separate your wealth preservation, which is gold, from your speculative capital appreciation, which would be Bitcoin and silver.
And that's the final question for you to consider. How disciplined will you be in separating those two objectives in your own portfolio? That is a defining question for the new year.
And with that, we come to the end of today's deep dive. We hope you enjoyed it, learned something new, and that you'll join us for the next one. Since tomorrow and Thursday we will be taking a short break for the holidays, we wish all of you who celebrate a very Merry Christmas. We will resume the normal schedule this Friday. Thank you very much for tuning in, and we will meet again very soon. Remember that in the description of this video, you can find PayPal if you want to help us out. Thank you once again for your support.